With 1.6 trillion in assets under management is Franklin Templeton. You're smiling, I know, it's a big number. Franklin Templeton Chief Market Strategist and Research Institute head Stephen Dover. Stephen, how are you gauging where to invest amid this macro headline-driven environment?
Well, what a day. It's interesting. You just presented all those pretty dramatic news events, and the market is mixed, right? The market is just saying, wow, all this drama, we don't know what to make of it, and we're making nothing of it. So I think that in and of itself is maybe the news of the day. The lack of drama, the resilience of the U.S. economy, despite all of this news about tariffs and kind of moving on to the possibility of tax relief, fiscal stimulus, as well as deregulation. The way that we are looking at this is that with all of this chaos and uncertainty, by definition, we don't know what's going to happen, so we're broadening our net. I talked to you, I think, around December, January, recommending broadening, including overseas. That's turned out to be a very good play. And we continue to think that the dollar will likely fall and there'll be opportunities outside of the United States.
Okay, specifically where? Would that be Europe? I mean, everybody's talking about the fact that Europe has finally hit a bottom and that, in a way, what President Trump has demanded is actually helpful to Europe because they realize, you know what, we have to start manufacturing more on our own. We have to start looking for better trade opportunities, perhaps elsewhere outside of the United States. So this almost feels like they are going to ramp up, certainly in Germany, they're going to ramp up the efforts here. So what do you see?
What I see is that the Europeans perhaps don't like the personality that they're receiving from President Trump, but he's actually hitting some points about Europe that's really needed to happen. Europe, particularly Germany, needed to have some surplus. They need to build up their defense spending. They need to build up their infrastructure and energy spending. So if we look at the United States and why it's performed so exceptionally the last 5 or 10 years, at least 3 reasons for that are, one, these extraordinary tech companies we have and their extraordinary earnings, massive fiscal stimulus that we got out of COVID, and frankly, just a more productivity-driven economy. None of that Europe had, and now Europe's starting to move towards that with fiscal spending, with Germany in the defense sectors and in the energy sectors. What Europe doesn't have is the productivity technology companies and really a mindset of productivity. So long-term, Europe still has some problems.
Well, look at the Dow. Sorry to interrupt there, but it is now looking to turn positive for the first time this session. At the moment, it's getting there, here and there. We'll see what happens. But that's a great, interesting focus when you talk about the opportunities elsewhere. But what about the Treasury picture? Because at the moment, we're starting to see at least some of the T-bills, the shorter duration opportunities, still churning out a 4%, close to a 4% opportunity. So do you like anything there?
Yes. Short answer is yes. We like the shorter end of the curve. I think the big news today is really the change in the long-term end of the curve, in the 30-year area. That's where the vigilantes, if you will, have come. And I think that you keep hearing that's because of concern about the deficit. And of course, that is a concern with long-term bonds. But I think the real issue is that we have a changing world in which we're likely to have inflation, that China is no longer going to be exporting deflation like it has over the last 30 years, and that the only way Republican or Democratic, both of which have fiscal deficits, the only way we get out of our fiscal deficit problem is a growing economy. And that's what the 30 years worried about. And over time, that's serious. We know that it's not just a U.S. problem. We saw a bond vigilante moment in Japan just this last month.
And didn't we see something with Jamie Dimon on Friday at the Reagan National Library, the J.P. Morgan CEO blurting out that he was pretty definitive. He said there will be crack in the bond market, a crack in the bond market. So what do you think he specifically meant by that, and how do you interpret it?
I think if there's something that equity investors should be looking at, It's the bond market, because the bond market is more likely to speak. So that this 30-year, this issue of the United States government being able to finance itself over the longer term is serious,
Yes,
because
yes.
if the Treasury ends up shortening the duration of the bond, it puts our government at risk when interest rates go up. And that could be a crack. Right now, they're not doing that, but there's less interest in that long-term bond. There's less interest in foreign investment. Foreign investment was at the margin really high this last year. And so it's very likely that there will be less foreign investment in the equity market. In fact, perhaps a little bit of pullback, but more importantly in the treasury market. And that's going to affect our interest rates. That affects our economy and
Right.
certainly our equity.
Well, let's take it to the place where those decisions are being made, Stephen. Thank you very much.